This is the Haulin Assets podcast, where we show you how to start and run your own trucking company. Ever wanted to go out on your own? Follow Chris as he goes through the highs and lows of running on his own authority.
Welcome, everybody. Welcome to the Haulin Assets podcast. Today is episode number 167, and it's a doozy. Look, just prepare yourselves for some pure entertainment, because today we're talking taxes, baby. Woo! All right.
Look at, I got my tax shirt on.
Over there.
And my new accounting shirt.
Even on YouTube, people can't quite see it, but Chris does indeed have a Keep Calm, I have a spreadsheet for that t-shirt with, it looks like an Excel file, but it actually kind of looks like a TARDIS for all the dorks out there like me. So we skipped past a few steps here, Chris. I'm Craig, and over there he's Chris. Hi, Chris.
And I brought a friend.
You brought a friend. You have a friend? I knew you brought someone, but...
Well, I'm going to call him a friend. He may not reciprocate that. But...
It's a friend.
Chris, introduce your friend.
So Jeremy with Tracking Assets. So he's a business partner in Tracking Assets that does trucking accounting, taxes, payroll, all that kind of fun stuff. And so obviously today we're talking a little bit about taxes and accounting.
Is that why you have the porn stash going on today? You told me it was military reg, but I don't know, man.
I've got it in military reg. I was getting a little lazy, so I grew a beard for a little while, and then sometimes I just like to shave it down slowly to like get the dirty eye from my wife, because she hates it. So I had a handlebar mustache that looked really good. Now we're down to this.
Anything for a little entertainment value. I will say this, okay, tax-wise, I just spent 3 days in Columbus, Ohio with a whole bunch of accountants, and I had a great time.
Really?
And I want to extend that today. So we're going to work on that. Before we do, of course, I need to remind everybody to go to HaulinAssetsLLC.com to check out full show notes. And make sure you go to motorcarrierhq.com for tools, tips, and the people that can help you make the jump from to owner-operator from employee driver. And trackinassets.com. What's the site people can go to? Where can they find it?
And that's one thing, we actually don't have a website up yet.
Chris.
So just Motor Carrier HQ. We've got some pages on it. We will... That's actually what Chet and I were talking about that the other day, and we need to get a website up for Tracking Assets.
Well, we will. But for now, motorcarrierhq.com. It's where you can also get my t-shirt, which is beautiful and desirable in every way. All right, Chris, before the main topic of today, anything you want to go over? We're recording on Veterans Day, which means only one thing.
It's Veterans Day. Happy Veterans Day. Jeremy and I are both veterans.
Happy Veterans Day.
Yeah, so appreciate everybody that's a veteran out there for your sacrifice, and especially your families. A lot of times we don't pay them their due tribute, but families make a lot of sacrifices when their soldiers, sailors, airmen, and Marines are serving. So we appreciate all of them.
I've got a bunch of family in Space Force. What do they call them? Spacemen?
I don't know. Good question. That's so new. Spacemen sounds good though. Space people?
Spaceman Spiff, I think was the old Calvin and Hobbes thing. All right. I guess it also means two things. Veterans Day means the election is over. We're done. Oh my gosh. Thank goodness.
We can move on with life. That now that we can get back to spending money, and
everybody's done holding their breath.
Yeah. So I'm glad the election's over, and hopefully that'll help the economy. Like I think no matter who got elected, it would be better than the situation we were in prior to the election.
I guess we'll see. Let's hope. But all right, now that we've got all the throat clearing out of the way, let's get on with our topic. Chris, how do you want to back into talking about taxes and being prepared for it? Where do you want to start?
Let's kind of start with, you own a business or you do some kind of business activities. Do you need to file a tax return? And because you've got an actual tax return that a business would have to file, just like you file your personal taxes. Or in some situations, you don't actually have to file a return. It just goes on what's called a Schedule C on your personal return. So Jeremy, maybe kind of walk us through each situation.
Yeah, I appreciate that. So a question that we often get from new clients coming into being a company driver, as you said, starting their own small business, and lots of questions. First off, I always want to say, hey, those questions can be answered. They're not that complicated. It's just a matter of asking the right questions and finding those resources. And Chris has done a great job with getting those resources out there and giving a lot of information. So most companies, as they start, elect to be a limited liability corporation with their state. There's some default tax structures that come with that. And so if you are a sole member LLC, you're going to be taxed as a sole proprietor. So it's just you. It goes.
And, sole member, meaning you're the only owner. You're the only one on the paperwork. You don't have any partners.
No partners. Absolutely. So it's you. You started this business. All of that information that you do with your business is going to flow through to your personal tax return. So we talked about that being on a Schedule C. So very simple. The IRS wants it to be simple. It's the easiest form of being able to report things. So let's talk about multi-member LLC. So you and your spouse, you and a family member, or you've partnered with somebody in the industry and you've got somebody that you're working with. As a default taxation, you're going to do a partnership return. So now both of you have to have a portion of the business earnings or losses reported on your taxes. So you file an informational tax return.
So wait, okay. You're filing an informational tax return. Back up. Why are we doing that, and what is it?
Absolutely. It's the IRS's way to divvy out and proportion everything to each of the owners. So it's still going to pass through to each of you, but the IRS wants to know how you're going to do it. So when it shows up on your personal tax return, they have something to match it to.
So this is the document that the IRS gets that says, okay, when these, let's say it's a partnership with two people on the paperwork, right? The assets or the profits from this company should be divvied up this way. So when you get these individuals' tax returns, as well as this company's tax returns, this is what it should look like.
Absolutely.
Right. So do you only have to do that one time when you start the company?
Yeah, so the informational return is an annual requirement. It's something that you're going to file just before the normal tax filing season for your personal taxes. So for a partnership return, that's March 15th of every year, unless it falls on a weekend, and sometimes that gets pushed forward a couple of days.
And that raises the next interesting point, which is, when do I have to do all this stuff? And you said March 15th, which should be setting off some bells in people's heads, because they're going, hang on, it's April 15th, right?
Mm-hmm.
My whole life I've filed my taxes by April 15th. But with this informational tax return, like we said, you're trying to signal, here's what everybody's taxes should look like. And so you're essentially giving the government an extra month to make sure that all the information is there, so that when your April 15th tax returns come in, they make sense. Is that fair?
It is, yeah. And it's on the business to provide that information with enough time for it to get onto a personal tax return.
Okay.
Yep, so the IRS gets it, and they've got the deadline really to benefit the individual, the partners within an organization, so that way they can file their taxes on time, which is in April.
So when somebody makes that leap, they go into an owner-operator situation, whether it's, whatever type of business entity they opt for, there's going to be different dates that they need to worry about, depending on what they choose, right?
Yes.
Do we want to go over some of those and what the benefits, or just what the benefits are, or what they need to know?
Yeah, so let's talk really kind of, and we've talked about the you're the only member of your company. We've talked about a partnership. Really, the only other one that we haven't talked about is if you elect to be an S Corp. That's a tax structure that the IRS has in addition to partnership and sole proprietor. And we can kind of talk about more on that. So with and an S Corp also has to file its own tax return. So partnerships, S Corps have a due date of March 15th. This coming up year, because it falls on a weekend, it's going to be March 17th. And then for a single member LLC, so you're that sole proprietor, it's April 15th with your personal tax return. So that schedule goes with it. And then all your individual tax returns. So if you are a partner, an S Corp, you're still going to file your individual tax return on April 15th.
Excellent. So let's move on then. We're actually going to move on to backing up to a different concept, which is why would you choose one thing over the other? And should we do a little disclaimer, Chris? This is not tax advice, right? Like you consult your accountant, consult your attorney. We're not here to tell you, individual listening to this, what to do, but we're going to present a few different scenarios and options, right?
Yeah, I think that's fair. And kind of like Jeremy said at the beginning, this is one of those situations where it's really not that complicated, but it kind of is to an extent because everybody's situation is a little bit different. And it takes somebody like Jeremy that's got the knowledge and the know-how to ask the right questions to help the client determine what is the right situation for them, whether it's to file as an S corporation or a partnership or just keep as a sole proprietor. So you need to give somebody a call, talk to an accountant. You obviously would love to have you talk to Jeremy at Tracking Assets, but don't try to make that decision on your own. Like it's complicated enough that you need to talk to somebody that really knows what they're doing, and they'll make it simple for you.
Right. It's so tempting to get on whatever Facebook group and just type out, hey, what should I file as? What kind of business entity should I be? And you'll get 10 responses and 8 of them will say this. So you'd be like, oh, that must be the right answer. And maybe it is, but they don't know you. They don't know your situation, right?
And everybody's trying to be helpful, but you're going to get a lot of answers. And so you do want to have somebody that you can feel like you can trust, that makes sense, that will look at your business as a whole and to kind of give you that advice, because everybody is a little bit different. We want to understand your structure before we make a leap into, hey, this is the right structure for you, or this is the answer, right?
And what would the two most common choices be? Single member LLC, like a sole proprietor setup, or a partnership?
So I would say like most of our clients elect to be an LLC. So they set up their business structure to be an LLC. And then as far as the tax structure goes, and I don't really want to go into why you choose one over the other. We've touched that a little bit in past episodes. And I think Jeremy kind of going forward is going to be a more regular guest. And so we can, talk about those kind of things on some other episodes. But so most people will select business structure wise to be an LLC. And so the most common tax structures in that is if it's just you as a member, you're going to be default tax to a sole proprietorship. If you have multiple members, it's going to default tax to a partnership. But then you can elect to be an S corporation if that's what makes the most sense. And so that's when you need somebody like Jeremy to come in, understand your situation, and help you make that election between those three. Those are going to be by far the most common that when you're starting out in the trucking industry that you'll choose. Right.
Okay. So what are we going to talk about next? Is this how we file taxes, or what we want to represent to the IRS? What's the most important thing to show?
Let's talk a really quick, a couple more things with dates, and then we'll kind of move on from there. So, Jeremy, talk a little bit about extensions.
Yeah. So a lot of our clients, I think if you're getting help with your books, either you've got yourself, a family member that's keeping up with it, that you've got a process that and you can summarize your financial data at the end of the year, you're going to be well positioned to meet the initial deadlines. So your March, your April deadlines. Let's say that you haven't been able to keep up, you've got some work to do, and you're coming up against that deadline. You can file an extension. You can file an extension on your own. There's lots of ways to do that. You can do that with your tax preparer. And that extension gives you 6 additional months. It doesn't relieve you from needing to pay taxes that you potentially could owe. So everybody's still responsible for estimating taxes, paying that by April 15th, or March if you've got business taxes or with the state.
So the extension is just for the paperwork then?
It is. It's for the paperwork to finalize your taxes with the IRS. And then if there's additional taxes and or oftentimes a refund to you, you've got more time to figure out what that is and to file that.
Okay. All right.
So that 6 months is if you're an S corporation or a partnership, that 6 month deadline September 15th.
Yep.
For basically everybody else, it's October 15th.
Yes.
Right. Okay. Now, anybody who is getting started with a new business entity and didn't go to business school, didn't get their accounting degree, they hear about quarterly taxes and wait, what? I have to pay taxes every 3 months instead of every 12? What's the story there?
Yeah, and I think this can be fairly simple and not to get overly complicated. The IRS has a few ways that they calculate it. One of the best ways is once you've filed one tax return, that tax return generally will give you an estimated taxes based off of your prior year. So if you're just starting off in the current year, obviously you don't know your operations, you can kind of give yourself a rule of thumb and pay a little bit along the way. But really it starts that second year where the IRS is going to start, hey, this is what you made last year. We're going to spread it out across the quarters, and here's kind of your estimated taxes. You can also use somebody like Tracking Assets or another tax preparer who will look at your current operations and help you generate a tax or an estimated tax due out based off of how your operations are going. But it's important to know that because you're self-employed and you're not a W-2 employee anymore, nobody's taking the taxes out for you, and that's where the IRS has put that on each of you as an individual.
It's one of the most shocking, and I knew it was coming, but still, it's a shock to the system. One of the most shocking things that I went through when I quit my full-time job. I was a W-2 employee, and then I started my own thing. And like you say, nobody's withholding any taxes from a paycheck. And so I file my taxes in April. And, for years and years, I was getting a refund. It was sweet because I was overpaying on, in my withholding. And now suddenly, the government's holding out their hand going, you owe thousands, buddy. Oh, no. And it's coming, but it still sucks.
Yes.
Right.
And those taxes are due the 15th day of the month after a quarter ends. So essentially like the 15th of January, the 15th of April, the 15th of July, and then the 15th of October.
And it's brutal.
It's
brutal.
Yeah.
But, the good news is that you're not actually paying more taxes. You're paying the same amount more, like, just spread out over the quarters, right?
Exactly.
It's the IRS does that to make it so people don't get themselves in trouble. Like that shock of that, I owe thousands of dollars in taxes. Well, maybe that's too much. You don't have that money on hand for a lot of people. And so that's why the IRS has just found it's better to make you pay a little bit up front so you don't kind of hurt yourself in the end.
Right. Okay. All right. So where do we want to go next, Chris? What's our next tax topic? I want you to wow us with your edutainment skills. All right.
Well, good luck with that. One of the most important things at this point that you kind of need to decide, we're going to really kind of jump into the tax planning piece. And so you need to know a couple things. Did I make money or did I lose money in reality? And then what do I want to show the IRS? You have to be honest with the IRS, but there's things you can do to kind of reduce your income that are completely legal so that you pay less taxes. But there's kind of a bad side about that people don't know. If you do that, you're also showing that you're making minimal profits. And then if you're trying to get loans and things like that from businesses and they see that you're not making a whole lot of money, you're less likely to get loans. So you kind of have to look at what you want, what your goals are, and decide, okay, do I want to maximize profits? And do I want to show that to the IRS so the banks see that? Or do I want to minimize what I pay in taxes, which is going to show a reduced profit, and I'll pay less taxes, but then I'm going to have a harder time getting financing from banks when I do that. So it's kind of a give and take. You have to decide what's best for you. So those are the two questions you're going to have to ask yourself.
Do you want to look poor or do you want to be poor?
There you go.
No, that's really interesting. And I'm going to try to restate that, not because you didn't explain it well, but because I want to make sure that people like me who are not accountants and don't have finance degrees or whatever are understanding. You can you brought in X number of dollars this year, $100,000. Congratulations, you're in six figures, right? So now you have to make the choice. Do you want to show a profit of $100,000 and have to pay taxes on all that? That's going to increase your burden. Or do you want to find ways to strategically show that it was actually a lot lower than that? I don't want to pay so much in taxes. So now, because of these adjustments, it looks like I made $60,000 this year. Yep. And so you're paying less in taxes. But when you take that tax return to the bank and say, I need a loan, they say, well, you can't pay back this loan on 60 grand. So no, we're not going to give you the loan. I'm super oversimplifying things, but is this directionally right?
Yeah, and I wouldn't say you're really oversimplifying it. That's essentially it. Yeah, and you may have been able to qualify for that loan if you showed $100,000 in profit versus
right.
the $60,000 in profit. So that's kind of the give and take in this situation. You've got to decide what is going to be best for me, and so keep that in mind. You've got to know that, and that's where it's a really good idea to have an accountant. I'm sounding like a sales guy, like Jeremy, that can kind of help guide you through that,
yeah.
and help you figure out what's going to be the best decision for you. What are your long-term goals with the business? Are you even trying to get financing? If you're not trying to get financing at all, that may make it a pretty easy question to answer. So talk to somebody that knows what they're talking about, and they'll help you make a good decision. That's one of the things, like with an accountant, it seems like they're kind of expensive. But in reality, what they can do for your business is worth their weight in gold.
Oh, absolutely. It's I was hanging out with dental accountants last week, and we talked about a lot of that sort of thing. Like, it's sure, you're paying, whatever, 10 grand for your accountant, and he's saving you 60 grand every year, whatever. So totally worth it. All right. So is it fair to say then that in broad brush strokes here, if a trucker is looking to expand, they want to actually build a fleet. So they've got one truck and they want two. They've got 5 and they want to go up to 10. Then in that case, financing debt is going to be very important. And so you're going to want to show as much income as you can. On the other hand, if you're an owner-operator, you're one truck, and thank you very much, I'm happy with that, I want to stay where I'm at, then it might be more advantageous for you to reduce that income as much as possible on your tax returns, right?
Yeah, that's fair.
Okay.
And I would even say, so that's where, again, the accountant's going to be able to, because there's a hybrid between those two, right? You may want to grow your fleet, but then you're saying to yourself, okay, how much income do I need to be able to show to be able to grow my fleet? And so you may be able to reduce that income some, but you don't want to reduce it as much as you possibly can. So that's where the accountant's going to kind of help you find out where that happy medium is, so that you can kind of accomplish both goals as much as you possibly can of reducing your tax bill, but still showing enough profit to get the financing you need. So let's kind of transition at this point then to talking about some of those strategies that you can use to kind of adjust where that tax bill is going to end up.
Okay. And there's going to be 2 different ways you can do it, right? You can adjust it on the business side and on your own personal side as well, right?
Yeah, you've got a little bit of play in both areas.
Okay, so let's start on the business side then. What are the most important strategies that people need to know about?
Yeah, so I just wanted to add one little thing about when talking reducing down your income and expenses and the 2 different strategies. As a business owner, you're always thinking, what is important and needed for my business? And I don't think that question changes with these 2 strategies. If we're reducing taxes, it oftentimes doesn't align with maximizing profits, but we're still always trying to look for, what does my business need? We're not trying to do excessive spending. We're always trying to look for what is most important to make my business successful. And so I think it's important to understand that that goal is always at the forefront.
Well, and this is just one more thing to bring up. You can hire all sorts of consultants and lawyers and whatnot, but your accountant has here's one of those Latin words that is important to know: a fiduciary responsibility, where, as you say, it's all about what's most advantageous for your business. And so it's really nice to be able to hire somebody who you pay directly, who has a responsibility to make sure that they're doing everything in your best interest. Mm-hmm. And so you don't have to worry about, somebody working on commission or whatever, where this person is going to give you their best advice because they have to legally. Mm-hmm. Ha 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 ha. Fair?
Yeah, absolutely.
Yeah.
Yeah. So kind of jumping into one of the biggest strategies, especially in the transportation industry, is the purchase of equipment. And purchasing equipment that may have different depreciation lives. So we've got tractor trailers, we have the trailer and different assets that come with the various styles of transportation and clients that we work with. So depreciation is a non-financial or non-cash deduction. And so I don't want to. I'm probably already confused by making that overly complicated.
Watching you struggle so hard to not use all of the acronyms and terms that you learned in school.
That's right.
Yeah, it's tough. It is tough. And this is, I should say right here, this is one of those episodes where if you don't have a background in accounting and whatnot, you might want to listen to this more than once.
Absolutely.
You can skip all the jokes and stuff, but this is important stuff, and it may be tough to get a handle on it first. But you'll catch on. Yeah. It's not so bad.
And so it's going to be one of your biggest deductions each year as you bring on new equipment into your business. There's also different tax structures that have been enacted. And I think the easiest terminology is bonus depreciation. So an asset that comes on in its first year has a bonus depreciation up to 100%. And then there's a couple of programs down to 60% and or just the normal depreciation.
Can we take a pause?
I was just going to
Sure.
say.
So let's talk. I want to say, like, with depreciation, is it fair to say that the two most common types are straight line and
you're killing me, man.
Just a second, I'll get to it. Straight line depreciation or that bonus depreciation,
Yes.
right? So straight line depreciation is if I buy $100,000 truck, and with trucks you typically straight line depreciate over 5 years. Is that right?
Truck is 3 years.
3 years?
Mm-hmm.
Okay, so let's say we go 3 years. So roughly 1/3 of that truck gets depreciated every year. So $33,000.
So you're telling, when we say depreciation, we're talking about, you're telling the IRS, I have an asset that is worth X amount of dollars, right?
Yes.
Mm-hmm.
And so as those 3 years go on, that number changes.
What is the number of what it's worth?
Right.
Yeah, but the depreciation amount with straight lines stays the same. You equally depreciate that asset over a 3-year period. So then with accelerated depreciation or bonus depreciation, like, you can depreciate, like Jeremy's saying, 100% of that in the year that you bought it. So you could, this is where the tax strategy comes in, right? Like, correct me if I'm wrong, I could buy that $100,000 truck on December 31st and depreciate $100,000 of it in that tax year.
Yeah. So the key kind of word for that on my side is that it was put into service. So you bought it and you are now using that truck.
It's on the
even
road.
if it's for 1 day.
Mm-hmm.
Yeah. So then at that point, that's the strategy you can use. Is now I made $100,000, but I just bought a truck that's worth $100,000 that I put into service this year, and I can depreciate $100,000. So you'd essentially show zero income for that year.
Mm-hmm.
I mean, that's kind of simplifying it, but that's essentially how that tax strategy works, so that you can do it. The downside of that, though, is then you don't get that depreciation benefit the next couple of years, because
Exactly.
you've realized it all in that very first year.
Yeah. So then that's where you really want to think through how and what your goals are, looking at your income and your growth as a company over the next couple of years. And then, working with somebody that can help you plan out, like, is it more important to take that this year versus having that spread out, expecting growth over the next couple of years and not having that depreciation to offset some of that.
All right.
So that's kind of like, to make this point, this is why it's so important that you start your tax planning early. I usually like to start mine end of October, early November, so really this time of year, so that if I want to make a move and I need to make a move, I've got time to do that. If I decide, hey, I want to buy a piece of equipment because I made so much money this year, I want that depreciation benefit. So you've got to start planning right now if you haven't already.
Okay. So if we don't start flying through some more concepts, this is going to be a 3-hour episode, right? Which,
it's so exciting.
I was just going to say, it's taxes. The people are clamoring for this, right? But let's go ahead and move on then. We've talked about depreciation and let's move on to expenses then.
Yeah. And so with expense planning, it's one of those items where what is best, this is where I want to emphasize, like, what's best for your company. And so you're still looking at that as a goal. So you're going to think, okay, I've had a great year. I am interested in reducing my taxes for the year. So let's look at, are there insurance that I want to prepay?
Or I need to buy 18 new tires for my semi truck. Do I do it in December or do I do it in January?
Yep. These are expenses are coming, that you've operated long enough to understand that, hey, this is something that I need, and I'm going to strategically place that into a year where I had excess income, knowing that these expenses are going to come up, and so you can take advantage of it.
Okay. All right. So anything else that we need to dig into on that?
No, yeah, I think just any expense that you can prepay. One other thing that I would, and maybe this is the next question, but negotiating those expenses. So now when you're talking prepaying, we'll talk to your insurance agent. Hey, if I prepay, is there a discount that I can get? If I buy bulk tires, is there a discount that I can get? If I buy bulk fuel, is there a discount that I can get? So negotiating with some of those vendors, reduced rate. So
trying to kind of kill two birds with one stone there and prepay both for the discount from the vendor and for the potential tax benefit for yourself.
Absolutely.
Okay. All right. Let's then talk about other expenses, capturing other expenses, accounting for deductions. Okay, there's a word that people know from their personal taxes. Let's talk about deductions and expenses there.
Yeah. So one thing that I don't, we want to remember as when you did your personal taxes, or if you had a small business at some time, you've probably had home office or heard home office deduction. That's changed a little bit over time,
especially after COVID.
So today you have to have a small business, which our audience is that. So you want to make sure if you've got an office space, there's you're using a computer somewhere, something dedicated within your home for your business. We can even extend that out to, hey, I've got this room that's all of my trucking stuff, or I've got a space somewhere in my garage where I'm storing all of my equipment. There's lots of different things that you can discuss, but that home office deduction is one that you want to think about and capture. You've also got other deductions, such as the use of a personal vehicle. So often a conversation I have with my clients often is, you've got your truck, you don't want to drive your truck to go pick up parts, you don't want to drive your truck to go talk to your insurance agent,
to go make those connections, right, for what's the word I'm looking for? Your direct carriers,
or going to knock on the doors of shippers that you might
Yeah.
be interested in working with. Yeah, all that stuff.
Keep track of your mileage.
Absolutely.
Yep. So keep track of that mileage, and you can use that standard mileage deduction, which is a great benefit to you and one that you want to take. So don't leave anything on the table. Childcare, if you've got young children at home that requires some childcare, those expenses can also be deducted. Make sure that you bring those up with your tax preparer.
One point I want to make on the home office piece, because this is kind of often misunderstood. What if I just rent? Do I have to own my home, or is there a benefit to me if I'm renting?
Yeah, good question. So regardless of owning the home or renting, that dedicated space within your rental, your home, is can count for that deduction.
Awesome. Okay, so that's the expense side of the ledger. Let's talk about the revenue side of the ledger. And I think this is the final thing we're talking about on the business side with tax strategies. So talk to us about revenue.
Yeah, not to overcomplicate it, trying to keep it simple. Most clients, most everybody elects to be a cash basis company. It's the easiest one. The IRS just wants you to be consistent in what you do. So cash basis, which means as the cash comes in or the cash goes out, that's when you put that on your financial statements or your tax return. So as year end comes up, if you're trying to maximize your revenue for the year, start trying to collect on those receivables that haven't come in. Talk to your vendors or get that revenue in and deposited into your account. And same thing on the other side. If you're looking to maybe push that out to the next year, say, hey, don't worry about paying me until later. And again, it's all about whether or not that cash is deposited.
I was going to say, like, you could do as simple as, I'm not going, like, all these checks that I received in December, I'm not going to deposit them until January. Like, you can do that, right? If you're working on a cash basis.
Does it matter when the deposit was made or what the date on the check was?
That's a good question.
Yeah, I mean, I'm probably on the more conservative side on that. Well, if you did receive a check, I would encourage you to deposit it. I'm more on that particular side. But again, if you're receiving things last minute and it doesn't make it in, that's another story.
Okay. All right. Anything else on the business side and how to high level abstract concepts of business accounting that we might want to be aware of?
I think that's probably about wraps
Okay.
it up for business. And there's a lot of things you can do on the personal side as well, but I don't think, this episode's already kind of turning into a probably decent length. That may be something we want to talk about at a different time, but there's a lot of things that you can kind of do on the personal side. And that's why a lot of times, like, it's good to have your accountant that does your business taxes also do your personal taxes, because then they can utilize different strategies in both areas. They know what's going on both sides. So I would highly recommend that.
Okay. So if we're trying to fly through this episode, then I've got a question for you, which is, what do I do if I've already created my business entity and I've been in it for 3 years, 5 years, and I haven't been doing all the stuff you guys talk about? I don't have an accountant. I haven't been doing quarterly tax returns and all that stuff. What do I just kind of slink into a hole and hope the IRS doesn't notice and keep my head down? What do you do?
Yeah, and this is more common than not, unfortunately. And really, the first thing that I want to say is, don't panic, don't feel overwhelmed. That will keep you slunk back in that hole and feel like this is an enormous task to undertake, and I don't even know where to get started. So, keep a level head and find somebody to talk it through and come up with a strategy. So really, where I say is, hey, let's start today. Let's figure out how your system is going and let's try to correct it moving forward. And then let's focus on the current year's tax return. A lot of what we can do is leverage a good year of tax preparation and then apply that going back and figure that out each year. So we want to catch up and we want to make progress. And so really, I say the little wins will get us there. So you just want to start small, focus on today, figure out how to keep up with it going forward, and then tackle that current year.
It's the old thing about the best time to start doing your taxes right was 3 years ago, but the second best time is now. Just do it now. Right?
Absolutely.
Okay, so any details on that you guys want to dig into?
Yeah, so as you kind of think through and find somebody to talk to, hopefully giving you a few ways to do that, you want to start gathering your resources. So companies that you use are a great place to start. If you're using a factoring company, they have statements that will give you all of your revenue for the year plus any expenses that you had with them.
Do you know how long they keep those records on average?
I'm guessing probably several years. I don't know if I've got an answer for that.
No problem. I was just curious if there's a standard out there.
Yeah. So if you don't use that factoring company anymore, they're going to still have your information, especially if it's, my guess is probably 5 to 7 years. But anything less than that, definitely, I'd expect that. Settlement statements. So if you're using a company to run under fairly regularly or only a handful, reach out to them for those settlement statements if you haven't kept those, or if you have, gather those up. That'll help give you an idea of income and expenses with that. Also, bank accounts, huge best practice. Have a business bank account. Try to funnel all of your business expenses there. I do understand that it is hard to have the cash flow sometimes that you need. So things could end up on a personal card, out of a personal account, borrowed money from somewhere. So you kind of got to gather those resources. But, using a business bank account, and we can talk Chris's love for spreadsheets. You can download that information and summarize it if you've got the time. There are also some bank accounts that will have a budgeting tool with that where you can categorize your expenses and it'll spit out some reports for you. So what you're talking about is one of the biggest no-nos that they teach you on day one of Accounting 101 is co-mingling, right? Where you go out for dinner with your spouse and put it on your business credit card. Well, that's not a business expense. And so now later on, you're going to have to figure out as you're going through these bank statements, like, wait, which ones were business expenses? And it's so difficult to do. Mm-hmm. You're never going to get it all right if you've been mingling your personal and business stuff. And so the more you can keep those separate, just put all the revenue into the business account, take all the business expenses out of the business account, and vice versa with the personal stuff, so that now if you were slacking off on getting those tax returns done and you've got to go back and try to figure things out from previous quarters, it's going to be a lot easier, a lot quicker than it would have been otherwise, right? And then I think so those are some of the ways that you could gather information if you haven't been keeping track of it. And then really, I strongly encourage any small business to have a strategy. I think one of the easiest ways, and there's several different platforms out there, is to get a financial tracking software that will gather all the information together. Obviously, there's time commitments for that. There's complexities to it. If you're needing that, partner with somebody. Find a bookkeeper, an accounting firm. Obviously, I'll plug in Tracking Assets. That's where that partnership really pays off, because we will continue to keep that up to date for you and with you. So that way at the end of the year, it isn't a scramble on, hey, what's happened? Mm-hmm. And avoiding multiple years and feeling that pressure of like, I haven't done this for years now. I don't even know where any of this information is. Okay.
All right. So I think that just about wraps it up. 45 minutes in. Chris, you look like you're jazzed. You're ready to go.
I'm ready to go. Let's do another 45 minutes, baby.
I've never seen you so energized in my life. But I do have one final and most important question, which is, does Tracking Assets have a G on it? Is it Tracking Assets?
No, it's just like the Haulin Assets.
Yes.
No G.
Oh, thank goodness. You got to keep that branding sharp.
Absolutely.
Yeah. Okay. So tracking assets then, and like you said, Chris, you can find more information about that if people are looking for a specific tool, a specific firm to use. Then that's somewhere they can go is to motorcarrierhq.com and look for info there. And if you can't find it, you're going through the navigation, just use the chat button, right?
Yeah. Yep. You can absolutely do that. So just one way or another, get in contact with Motor Carrier HQ, and we'll get you hooked up with Jeremy and his team, and
Awesome.
just set on the right path.
I feel ready to go on and just take on my day and do a whole bunch of taxes, guys.
Sweet.
I love it. Yeah,
I know
let's
you
do it.
It's one of those. I love that there are people like Chris. He's got his spreadsheet shirt on, and I break out in hives every time I think about a spreadsheet. And so people like me are really grateful for people like you guys. So don't. This is like Blue Oyster Cult. Don't fear the tax man, who does sometimes feel like the Reaper. That was Blue Oyster Cult, right? Don't fear the Reaper?
Sure. Whatever.
I'm pretty sure. Anyway, it's not that scary, especially when you got somebody in your corner. So whether it's tracking assets or somebody else, find somebody to put in your corner and simplify this for you. It's worth the expense. I can just about guarantee that. If they're anything like a decent accountant, it's going to be worth the expense. And it'll make your life a lot easier. With that, gentlemen, thanks so much for coming in. Especially Jeremy, welcome to the show.
Yeah, thank you.
And hope we get to see a little bit more of you.
Absolutely.
Next time we'll make it a party.
That's right. We're going to get...
Chris will get the confetti cannon.
Oh, yeah. I can do that again?
Yeah. I'm still picking confetti out of this dang studio. Anyway, thanks, guys. And thanks to everybody for listening. And we will see you all next time.
See you then.